Hello and welcome to this screencast in which we will talk about short sales. A short sale simply means selling securities that you don't own at present. So how can you sell something that you don't own? Well, you can borrow securities from your broker and sell them. In a previous screencast, we talked about securities held by the broker in street name. It is these securities that the broker can lend to you so that you can make a short sale. Now the question is, why would you make a short sale? And the answer is simple: because you are expecting the price of the concerned security to fall. Let me at this point introduce you to a term called the settlement period. Settlement period, my friends, is the length of time between the transaction date and the settlement date. So then what is this transaction date? The transaction date is the actual date of sale. And what is the settlement date? As the name suggests, the settlement date is the date on which the trade must be settled. That is, the buyer must pay for and the seller must deliver the securities. Settlement period, my friends, is usually written as T+1 or T+3 or T+5, depending on what length of time has been stipulated. Now let us return back to the short sale. The question is, why would you make it? And as we said before, you will think of making a short sale if you expect the concerned stock's price to fall. Let us suppose that you short sell a stock of ABC Incorporation today, which is priced at $50 per share. You need not own the stock to sell it. What you can do is you can simply borrow the shares from your broker. Remember, this loan is not in dollars, it is in shares, so that when you want to repay it, you are going to replace the shares back with your broker. By the time the settlement date arrives, my friends, the stock price, let us say, falls to $48 per share. Now two things are going to happen. Number one, you are going to buy the shares at the rate of $48 per share and repay your loan. When you repay your loan, we say that you are covering your position. And then the second thing is that you are going to collect $50 per share from your buyer, thereby making a $2 per share profit. Of course, if the stock price rises, you would be in a loss-making situation. Let us say if the stock price went up to $52 per share, you would still have to cover your position at $52 and collect $50 from your buyer. In the process, you are going to lose $2 per share. To end this screencast, my friends, let us enlist some good and some bad things about short sales. The good is that there are profit-making opportunities when the stock price declines, and the bad part is that since the profit depends on a fall in stock price, the return is limited because the stock price cannot fall below zero. On the other hand, the risk is unlimited because the stock price can go up by an unlimited amount. Also, unless there are proper checks and balances, short sales can cause significant volatility in the markets, because when shares are sold short, there is going to be a downward pressure on the stock prices, and when the investors rush to cover their positions, the opposite is going to happen. So all in all, a short sale is a way of making money in a market that is expected to fall, but like many other investments, it has its risk. Of course, the risk can be curtailed through the use of derivative instruments like options, but that then would be the subject matter of another video. For now, it's bye-bye. Thanks for watching.